In this video, we are going to talk about option arbitrage properties. So these are properties of option values that must hold, or else there's the opportunity for an arbitrage. Again, in the market, we would expect all of these to be true. But again, it's important to look at and important to think about at least how option values are related to each other and related to other things. So we're going to talk through a few of these. First, American versus European options. An American option is worth at least as much as the corresponding European option. Corresponding here means that the same underlying asset, the same strike, the same maturity, it's a call or a put. So we have American calls are worth at least what European calls are worth, and American puts are worth at least what European puts are worth. Now, this is true because an American call option has the same exercise opportunities that a European call option has, and then some. So imagine for a second, and generally we can do this. Let's say this did not hold. So we had the European call is strictly worth more than the American call. So the European's worth more than the American. Well, generally with arbitrage, you buy the thing that's cheap and sell the thing that's expensive. So we're going to buy the American call option and sell the European call options. Now, because the European call option in this instance is worth more than the American call option, we make money up front. Now, for both of these, we have the right to exercise the American call option early, but we're going to choose not to. So do not exercise early. Wait until maturity. And then, if the options end up in the money, remember they have the same strike. So if the options end up in the money, we're going to exercise the option that we own. So we're going to buy the stock or asset for the strike, and then we're going to turn around and sell the stock or asset for the strike through the European option. The exercise is going to net out. Basically, the money we pay to buy the stock, we're going to receive when we sell it. The stock we receive, we're going to sell. So the exercise nets out. What does that mean? It means that it doesn't matter what happens in the future. So the money we made up front, we get to keep. And of course, the same is true for the put. All right, upper bounds. So these are maximum option prices. First, the call option. An American or European call option gives the holder the right to buy one share of a stock for a certain price. This means that an American or European call option has to be worth less than that stock. Again, let's look at why. And we can think about this. What happens if this were not true? So let's take the American call option, for example, and assume it's worth more than the stock. Well, again, same principle as before. Buy the cheap thing, sell the expensive thing. So we sell the American call and we buy the stock. And again, we make money up front. Now let's think about what happens. There are two possibilities. Possibility one is that the American call is exercised at some point during the life. What does that mean? Somebody else exercises, they pay us the strike, and they buy the stock from us. Well, that's okay for us because we own the stock. So we give them the stock, they give us the strike, we make more money. The other possibility, of course, is that they don't exercise. Well, if they don't exercise the option ever, then we own the stock and we sell that for whatever it's worth. We made money up front, therefore we've made money as well, which means there's an arbitrage in the market. So what that means is that the European call or the American call has to be worth less than the stock, or less than or equal to the stock price. put options have a similar upper bound. So for a European put option, we know that at maturity, it can be worth more than the strike, right? No matter what, we have the right to sell a stock for the strike. So at maturity, the European put option cannot be worth more than that. Therefore, the European put option value is less than or equal to KE to the minus RT. Now, KE to the minus RT is the strike discounted to today. Another way to think of that is KE to the minus RT is a zero coupon bond paying K at maturity. Again, we can do our same trick and say, well, what if the put price were bigger than KE to the minus RT? What do? Well, the put's expensive, the zero coupon bond's cheap. So buy zero coupon bond paying K at T and sell the put. Okay, we make money up front, right? P is strictly bigger than KE to minus RT. So we make money up front. What happens at maturity? We've sold the put. Either someone exercises or they don't exercise. If they exercise, we buy the stock and give them K. But we had the zero coupon bond, so we have K. So we buy the stock, we give them K, now we have the stock, we sell the stock, we've made money at the end, whatever the value of the stock is, we made money up front. Version 2, they don't exercise the put option. If they don't exercise the put option, then we have the strike, right? Because we have the zero coupon bond. So we have K, we make money at the end, and we made money up front. In either circumstance, we make money, there's an arbitrage. For an American put option, that could be exercised immediately. And so similarly, we do the same sort of thing, but now we always need the strike. So P is bigger. If the American put option were bigger than the strike, we sell the put, we put the strike in our back pocket waiting. We make a little bit of money up front because we got more than the strike. And then if anyone ever exercises, we have that money, the strike. If they don't exercise, of course, we get to keep that money. So again, in either case, we make money. In either case, there's an arbitrage. We are assuming that as a client, we are a client in the market, there are no arbitrage opportunities like this. The only sort of pseudo arbitrage that shows up is through the bid-ask spread. So we can't make money for free, so neither of these things can happen, which means there's an upper bound for put options. All right, we have lower bounds. Just like upper bounds, we have lower bounds, the minimum option prices. So a European call option must be worth at least the present value of long a forward contract or zero, which is a little bit of a mouthful. Mathematically, European call option is bigger than or equal to the maximum of F minus K e to the minus RT. That's the present value of long a forward contract or zero. Now, certainly it has to be worth zero because you're always getting paid at maturity. If the call were worth less than zero, then you would have a problem. You would have free money. The reason for the other condition, at least present value of long and forward contract, is as follows. We know with put call parity, call minus put is the present value of a forward contract. We know the minimum value of a put is also zero, which means that call minus a put is less than or equal to the value of a call, right? The put could be worthless, call minus a put could be equal to the value of a call, but if the put is not worthless, then the European call option is worth more than the call minus put. And of course, that means that the call is worth more than F minus K e to the minus RT. Now, the reason for the maximum of this and zero is sometimes F minus K e to the minus RT is negative. right? And if it's negative, we have a stricter condition, which is the call has a positive present value. Now, we've got this arbitrage condition. If it were not true, then the call is too cheap, right? So if we had, for example, either the call is less than 0, that's kind of boring. That means always buy the call, someone's paying you. But if we had, for example, the call is less than f minus k e to the minus rt, that would mean the call is cheap and f minus k e to the minus rt, long and forward contract, is expensive. Buy the call, sell the forward. Why do we do that? Well, if we buy the call and sell the forward, then through put-call parity, what we really own is a put. So we buy the call, sell the forward, we own a put. But of course, if the call is cheap relative to the forward, then we're going to be paid to do those trades. So buy the call, sell the forward means we're paid to own a put. So there's an arbitrage. There's also a lower bound for European puts, which works pretty much the same way. A European put must be worth at least the present value of short a forward contract, or 0. So P is bigger than or equal to the maximum of K minus F e to the minus RT, that's the present value of being short a forward contract, or 0. Again, this is put-call parity. Minimum value of call is 0. So now, changing signs, normally we have call minus put equals present value of a forward contract. Changing signs, we have put minus call is equal to the present value of being short a forward contract. And now we have exactly the same argument that because the minimum value of a call is 0, the put price, the European put price, is bigger than or equal to the European put price minus the call. Again, if the put is too cheap, then we buy the put and buy the forward. If we buy the put and buy the forward, what happens? We are long a call. Now, what's a little bit strange here, just to mention it, buy the put and buy the forward. In the previous example with lower bound of European call, we bought the call and sold the forward. Here in this one, we've got a little bit of a double negative. So what we're really doing here is buying the put and selling the short forward. Selling a short forward is, of course, going long the forward or buying the forward. So we buy the put, buy the forward. We own a call. If the put is cheap relative to that forward contract, then we're going to own a call and be paid to do so. If there's no forward contract, we have a small problem here, but not an insurmountable one. So let's say we've got a call option that's trading too cheaply. You should buy the call and sell a forward, but let's assume there's no forward contract to trade. Then selling a forward contract is equivalent to shorting the stock and buying a 0 coupon bond, paying the strike. Buying a 0 coupon bond, paying the strike is equivalent to investing cash today where you receive the strike at maturity, right? So we can do those trades, even if we can't trade a forward in the market. Okay, so let's do some examples here. So suppose that call value is 3, spot is 20, 1-year option, interest rates are 10%, continuously compounded. The strike is 18, there are no dividends. The forward contract here is worth $3.71, right? So we do the forward contract spot, e to the RT, minus the strike, e to the minus RT. So $3.71. Question is there an arbitrage opportunity? Again, we know, just write down put call parity. Call minus put equals present value of a forward contract. Okay, 3 minus P equals 371. That means put call parity means the put has negative value, which means we have an arbitrage. We want to own the put, which is buy the call, sell the forward. So buy, call, sell, forward. right? That's a synthetic put. So that makes us own a put. We buy the call, $3, sell the forward, $3.71. So we're paid 71 cents to own a put. So there's an arbitrage. Buy the call, sell the forward. You're paid 71 cents to buy a synthetic put. If we didn't have a forward contract, we can still buy the call and trade the forward. How? We short the stock, invest the cash. So that works. Okay, so we short the stock, receive $20 in cash, we buy the option for $3, and we invest $17 at the risk-free rate. In 1 year, the investment turns into $18.79. If the share is less than 18, which was the strike, we buy the stock, we close out the short, our profit is $18.79 minus the share price. If the share is greater than 18, then we exercise the option. We pay $18 to buy the stock, and our profit is the $18.79, what we received from our investment, minus $18.79. So we always make money. Put option. Let's say we've got a put trading at $1, stock's 37, maturity's half a year, risk-free interest rates are 5%, the strike is 40. The forward contract here is worth negative $2.01. So again, we're going to write down put call parity. Call minus put equals present value of a forward. Call minus 1 equals negative 2.01. Okay, if we rewrite this, we get call equals negative 1.01. There's an arbitrage. There's a synthetic call that we can trade with negative present value. So, call has a negative present value. We want to own a synthetic call. If we want to own a synthetic call, again, put call parity says a synthetic call, rewriting our put call parity, call equals put plus present value of a forward. We want to go long the put, long the forward. Buy the put, buy the forward. You're paid $1.01 to own a synthetic call. Next, we're going to talk about early exercise. Generally, you have some probability that you're going to exercise an American option early. An exception to this is an American call option on a non-dividend paying stock, and you should never exercise this early. So let's think about this. Assume stock pays no dividend and no interest rates are positive. We know that an American call option is worth at least what a European call option is worth. And we know that the call is worth more than a forward contract, right? That's put call parity. Call minus put equals the present value of a forward. So we know the call is worth strictly more than a forward contract. Now I can rewrite this formula where F equals SE to the RT. So if F equals SE to the RT, we plug that into our equation and we find that the call is worth more than the present value of a forward contract, which is equal to S minus K e to the minus RT. That's a European call. Now, if we exercise an in-the-money American call option today, we're going to make S minus K. So the real question here is, which is more valuable? S minus K is smaller than S minus K e to the minus RT. K e to the minus RT is a smaller number than K, right? We're discounting cash, so that's a smaller number than K. And remember, we made interest rates positive here. So that means that S minus K is smaller than S minus K e to the minus RT. That's strict. That's smaller than a European call option, which is smaller than an American call option. So let's think about the implication here. The implication here is that if we exercise an American call option, we get a sum of money, S minus K, which is less than the value of a European option, which means that we must be leaving money on the table, right? So that if we're leaving money on the table, that means don't exercise early. What does that mean? Well, the implication is don't exercise early. Never exercise an American call option. Now remember, there are two assumptions here. One, the stock pays no dividend, and two, interest rates are positive. If either of those things are not true, then we might exercise the option early. And why do those matter? Well, the e to the minus RT in this equation for the forward contract drives part of this. If we had negative interest rates, then our assumption here about the relative size of these quantities would not be true. And second, if there were dividends, then our assumption F equals SE to the RT is wrong. F is going to be something different. We're going to subtract the present value of the dividends. And all of a sudden, again, this inequality here is no longer true, and therefore we can't make the assumptions. Now, this raises the following question, which is, what do we do if the stock is going to, we think the stock's going to fall in value? We have an in-the-money American call option. We think the stock's going to fall in value, so we'd like to exercise, because we say to ourselves, look, we've made lots of money, we'd like to exercise, but it turns out that's the wrong thing to do. The thing to do is to sell the option. Now, when you exercise an American call option, why are you doing it? Or one of the reasons you might be doing it is because you want to own the stock. Well, if you want to own the stock, then sell the option, buy the stock. When you sell the option, you receive more than S minus K, so you buy the stock and you get the stock. Now, if you don't think the stock's going to fall in value, and you're just wondering, should I exercise now or not? The answer is no. You should hold the option until maturity and exercise then. But if you're meant to hold the option until maturity and exercise then, that means it's got the same value as the European option. Now, if there's a dividend, you might exercise early. And the exercise opportunity is just prior to the stock going ex-dividend. So the day before the ex-dividend date are your early exercise points for an American option on a stock which pays dividends. And I've certainly seen this in the market quite a few times where the right answer was exercise early. So exercise on that day before the ex-dividend date, and people didn't exercise early. What happens? On the day, the ex-dividend date, the stock price falls, the option value falls, you've missed the early exercise opportunity, and you've lost money, right? The option told you exercise, you decided not to, you're going to lose money. Finally, we should talk about puts, just to show that this doesn't work for puts. So take an extreme situation. Strike price is 10, the stock price is basically 0. If you exercise now, you make $10. If you wait, the maximum gain is $10, but you might receive less than $10 if the stock price goes up. You'd rather exercise now than wait. Why? Because you're going to get $10 now, and that's worth more than even if you knew with certainty. Let's say the stock had defaulted, and so it was always worth 0. Generally, $10 now is worth more than $10 in the future. Of course, embedded in here is that interest rates are positive.